Good morning, investors. Welcome to the February 4th webinar presented by Portfolio Builder. Folks, want to welcome you all in. Thank you very much for taking the time to join us here today. My name is Dean Gallagher. I'm an investment consultant and partner here with the firm. Folks, what I do specifically is help people understand what we do, how we are outperforming markets, and explain how we help our clients grow not only their capital, but also their knowledge base when it comes to investing in the equities market in the United States of America, the most liquid market on planet Earth today. Okay, so welcome in, folks. Thank you so much for your time. Real quick, folks, what I'm going to do here is just take you over a brief overview of our Safe Alpha portfolio. Okay, and today we're seeing a little bit of a pullback in the portfolio. Not worried about that in any way, shape, or form. Extremely confident, folks, that this portfolio will continue to massively outperform the S&P 500. Okay, so if you're just joining us now, before we started up the webinar, we just did some quick math to understand how we are outperforming the market by a factor of 4.48x, okay, or the equivalent of 448% outperformance to the S&P 500. Okay, so folks, pretty simple here on our portfolio overlay here. Okay, so this is our most basic product. Okay, most basic portfolio to build. Currently, it's only 4 ETFs, right? So it's going to take you literally 1 minute to build out with your own capital. Okay, but the brilliance of what Jason has built is really, really neat. Okay, so let's go ahead and dive into that. So I'm going to do the 10,000 foot overview. Jason's going to dive much deeper into what we're doing here. Okay, guys. So our top asset is the TQQQ ETF. Okay, so this is the best performing ETF, folks, that has ever been created, bar none. There's nothing else that beats it in the market. On top of that, guys, this ETF also is the #1 performing asset, okay, over the last 11 years in the stock market. You can take any stock that exists, Tesla, Google, Apple, I don't care, you name them, over a $10 billion market cap. Literally, folks, nothing has outperformed this ETF over the past 11 years, over a $10 billion market cap. So sure, there's some garbage underneath that market cap that you don't want to own, right? That's ultra risky, that has outperformed. But why would you want to do that when you can actually spread your risk across 103 of the best companies that exist today? Okay, that's what's represented inside of the TQQQ ETF. Now, guys, it's really cool because this ETF actually pays you to leverage your money. Okay, so if you go to your broker and you ask them for 3-to-1 leverage, I did this actually in Q4 of 2020. And I said, hey guys, I went to TD Ameritrade. Love the broker, right? Obviously, we're using the Thinkorswim platform here. And I said, hey guys, what would it take to leverage my capital at 3-to-1 for the next year? And I very seriously assessed that. And I calculated the fee, guys, and it was going to be $56,000 a year to leverage my money at 3-to-1, all of my accounts, right? So I said, good God, why in the world would I pay the broker $56,000 a year when I can actually own this ETF and they're going to triple my money and they're going to pay me to do it, right? So kind of a little bit of an aha moment for me personally, right? I study investments ferociously, folks, and you know, it's a huge allocation of my time, and I saw that and I went back. I went, just why in the world would you do that when you can own this instead? And by the way, guys, when you own these are the companies and the people that control governments, that control our central banks around the world. Okay, and they're going to ensure that they go from being billionaires to trillionaires. So kind of neat to own, right, and ride on the coattails of the richest people on the planet that have full and complete control over the financial systems. So that's why this is our largest position in the Safe Alpha portfolio. Next, guys, is our COPEX position. Okay, these are all ETFs too, right? No individual stocks here, right? You want to, for me, guys, I love eliminating individual business risk, and I love owning baskets of assets, of the best assets there are, instead of just individual companies. And once again, with the TQQQ, you can't get better performance over the last 11 years by just owning this thing in the market. Okay. Next, guys, is our COPEX. Okay. this is our huge play, okay, on a few things. Number one, the Belt and Road Initiative. If you haven't studied that and understood it, you should. Okay, that is going to require a massive amount of copper. We're going to see more copper extraction from the earth than we've ever seen previously in human history. And this ETF and the companies inside of it are going to be a massive beneficiary. Okay, next, folks, let's take a look at the best currency deflation hedge that exists on planet Earth today. And I don't care what country you're sitting in today, folks, this is literally the best, bar none, currency deflation hedge that exists on planet Earth today. Okay, this is GBTC. And for all of you that have a 401k, IRA, TSP, RISA account, okay, depending on where you are, tax deferred accounts, guys, guess what? This is the easiest way to get exposure to Bitcoin. Okay, and you can get FDI insurance up to $150,000 on your position. Pretty cool. You can't do that with Bitcoin otherwise. Okay, next, folks. Okay, we have UVXY. This is our disaster insurance. Okay, this is the asset that if the market tanks, this is going to fly. Okay, and absolutely keep us safe. So we're using some leverage here. Okay, because if you certainly want to be using leverage during times of quantitative easing, folks. Okay, look, your money's devaluing. I don't care where you are on the planet, anywhere from 10 to about 25% globally. Okay, in the States, you're looking at 10 to 15%. Canada, you're looking at probably about 20% that your cash is devaluing at each year. Okay, so don't do that to yourself. Don't do that to your family. Okay, guys, get in assets. You're going to be punished to be a cash holder. You're going to be rewarded to be an asset holder. Okay, so these are the 4 core assets that we hold in our Safe Alpha portfolio. Why do we call it the Safe Alpha? Well, guys, this helps keeps us safe. This also, our currency hedge, not only works as a currency deflation hedge, but folks, over the last literally really 4 to 5 months when markets are down, this has been a wonderful hedge, okay, on top of that. So kind of dual purpose here. So we have 4 separate assets. They all counterbalance against each other, right? So we have our growth right here. Okay, we have our big play on the unstoppable macro play that's going to hit planet Earth for the next, at least decade. Okay, so we're going to be pulling more copper out of planet Earth than we ever have before. So you want to own those companies. They're going to massively profit from it. We have our growth here from the companies that literally own and control the financial system completely. The governments around the world, you name it, they control it all. Okay, and then we have the best currency deflation hedge that exists today. So, guys, that's how we've had, and our returns ticked up here to $115,000 for the year, or basically 11.5%. But when we did the math earlier before we did start up the webinar, okay, we did have a 11% gain. It's over that now. But if we look at the S&P 500, it's only at a paltry 2.45%, right? So if you're just holding the S&P 500 currently, okay, or you have a mutual fund that's just holding that, your returns are 2.58%. And unfortunately, you're just barely beating inflation at this point in the year, guys. Conversely, our Safe Alpha portfolio is up 448%, or 448% outperformance to the S&P 500. Okay, running here at 11%, and it's actually over that now. But markets are dynamic, so these numbers will fluctuate. Okay, so pretty cool, guys. This is the Safe Alpha portfolio. I just wanted to do a quick overview on that. And with that, Jason, I'm going to hand it over to you so you can go deeper into it and help these people get a risk parity portfolio built out today. And folks, our goal is to have you grow your capital more than the cost of our service fee so we can continue to help you through the next year and following decades.
Okay, beautiful. All right, guys. So the way we recruit team members into our program is actually giving you the formula for success and asking you to test drive the investment vehicle. And that's really been the secret to how we've grown over 1,000 members with just a tiny little team here. Dean, can you tell everybody about this screenshot that I have on my screen right now?
Sure, Jason. So real quick, folks, this was a screenshot that I received actually on March 16th in 2020. Okay, so for those of you that know the market real well, that was the worst sell-off day statistically in 2020. Okay, we went limit down twice, right? So we hit limit down at 6%. They shut the market off for 5 minutes, and then we went limit down again at 9%, right? And they shut it off for 15 minutes when that happens. So if you remember that day, if you were checking your portfolio, you're probably looking at losses, six figures, seven figures, you name it, depending on the size of your portfolio. Okay. And it was really cool, guys. That same day, our pro portfolio members are bragging about how much money they're making in our webinar. And I got a text actually from a gentleman that was on a free trial that day. And he said, "Hey, Dean, check your email when you get a chance. Profits look good." And so I did. And this was the screenshot that Ron had emailed me. Okay. So as you guys just saw on the Thinkorswim platform there, you were looking at the activity and positions, right? So basically you can see the assets here. This is what Ron sent me a screenshot of. Okay, so he was on a free trial with us. He really was looking for a really safe system to invest quite a bit of capital behind. Okay, and so he was pretty confident with what we were doing. So he put quite a bit of money behind us on his free trial. He put 584K behind us, guys. And in the worst sell-off week and the worst sell-off day of 2020, he made $97,000. Okay, so these are positions we don't have at this time. Okay, but you can see the positions over there on the left. And when Jason scrolls back to the right, you'll actually be able to see the total profit that he had at that point in time, guys. Okay, so it's a little blurry on the screen. That will correct in just a second here, but you can see all the positions in our defensive side of the portfolio, guys. Produced a $97,000, $19.89 profit during Ron's free trial. So pretty cool to see that, guys. And really 99.9% of the world was not making money on that day. But this is the beauty of risk parity. And this is literally what we got from a trial member on our portfolio. And now he's one of our clients today. And it was really cool, Jason. My favorite part of the whole story is his girlfriend actually had a pretty large account with Goldman Sachs. She had about 3.6 million at the time with Goldman Sachs. Her drawdown that week was actually and her drop was just shy of $1 million. And it was funny because Ron's sitting there bragging to her about his profit. And long story short, he ended up taking her on a vacation. But I thought that was just really cool.
That's such a great story. And you know what? We want to contrast this. We've actually brought one of our clients who joined our customer support team, Jeff Olson, on today. Jeff, you out there?
Yes, sir, Jason. I'm out here.
Okay, well, let's make people feel a little better who had the same experience as you in March. Can you tell everybody your story?
Yes, sure. For every good story, there's the other side of the coin. And I'm here to tell you my story. My name is Jeff Olson. I live 15 miles outside of Southeast Denver. I have been a member, I've been a client, a client of Portfolio Builder for 10 and a half months. But my story really starts back in 2008 when I left a privately held company that once you don't work there, you can't own stock. And so they cashed me out and I had a chunk of money. I wasn't sure what to do with it. I realized I'm pretty far behind at 40, early 40s, that I'm behind where I need to be in my retirement accounts. And so I dove into these financial subscriptions that are all over the country. This was 2008. I spent over the next decade, I kid you not, I spent between my annual re-ups and my trying new subscriptions, I spent about $25,000 just on fees up until 2020 when I met Dean. But what happened in March of 2020 is the other side of the coin from the story they told about Ron. His free trial, he made 97,000. My experience was quite different. My experience was that I kept telling myself that tomorrow is going to be better, that this is going to end, this slide is going to end. And it did end. And when it ended, I was fortunate that I didn't lose 6 or 7 figures. I only lost 2 figures. Those 2 figures were 4 and 0. I lost 40% of my trading portfolio. So I'm not a wealthy man, that hurt a lot. I didn't know what to do. I was devastated, and I went to cash and I turned off my computer and I ignored everything for a couple of weeks. Then I realized whining about it won't get me anywhere. So I jumped back in and I started searching and I said, there's got to be something better. I found on YouTube, I found this thing, Portfolio Builder, and I really liked what I saw. And I just tried my 7-day trial. I enjoyed it a lot because I started hearing something that I never heard in a decade prior. And I kind of think now that's all by design. You have to tell me that there's not other people out there that don't know this, but no one ever told us or taught us about the theory of risk parity and hedging for volatility in the market to basically to make your portfolio bomb proof. And I never had that. And so when Ron was making money, I lost 40% of my portfolio. But I joined what is today Safe Alpha. I said, hey, I like these guys a lot. They're teaching me something. I like Jason, the way he speaks, the way he puts politics and economics and everything into regular speak so that we can all understand it. I liked it. A couple months went by, I did well, and I joined the next level. At that point, I had an opportunity to join the boot camp, and it was a boot camp for life. I was doing so well, and I liked these guys so much that I decided that my search for the financial subscriptions was over, that I found what I was looking for, and I went all in with these guys. That was last June. I don't think I've missed a webinar, but maybe 3 or 4 in my whole entire time in 10 and a half months. I enjoyed so much. But where I've come today, in 10 and a half months, I have all 3 programs, and I utilize all 4 portfolios. From the 40% I lost 10 and a half months ago, as of the start of this meeting, I have recovered 67% of my lost dollars. So then, hoping that in a few months, I'm back to where I was almost a year ago. I'm whole again, and I can take off. And that's my story, guys. And I appreciate your time and letting me tell it. Thank you.
And Jeff, just real quick, bud. So since you started working with us to now, you're up, what was it, 63%?
67% as of the start of this meeting.
Good Lord. Good job, Jeff.
Yeah.
I love it.
Good job, you guys.
Awesome. Very cool, guys.
Oh, go ahead, Dean. Sorry.
Oh yeah, I was just gonna say. So Jeff, and it's really cool, guys. I'm so fortunate to be able to say this, but Jeff is our second client turned team member. Okay, I guarantee you can't go find another financial services firm that has literally clients turned employees. Okay, or we call them team members. Most other people would call them employees, but pretty cool. Jeff is our second client turned employee. So just want to give you guys kind of the general background there. All right, Jason.
Okay, great, guys. So just a disclaimer, we have to say this: for every positive testimonial, there's likely an opposite testimonial that's had the exact opposite in losses. Okay, so that's legally what we have to say. Now, what I want to do is show you what makes our program so popular. Let's see what is going on here.
Yeah, it was the same error Google was giving me earlier this week too, Jason. I don't know what's going on with Google Sheets. They must have some type of glitch going on. All right, guys, and we'll get that cleared up in just a second here. And apologies, our spreadsheets are built with Google's technology, and it looks like they're having a little bit of a glitch here today. But we will get you guys the portfolios built out in just a moment here. Okay. Well, looks like that one's working good.
Yeah, that's really weird. I'll have to get into that. Okay, well, let's go ahead and jump into the presentation. Dean, can you flip to your screen for a second while I fix a spreadsheet? Yeah.
Yeah, absolutely, bud. Okay, folks, thanks. And we're going to switch right over here. And so you guys saw the Safe Alpha portfolio first, okay? But next, let's actually take a look at our portfolio that's smashing the returns of the Safe Alpha. So if you said, wow, these guys are outperforming by 448%, that's neat. I want to do that. Well, let me show you actually our more aggressive strategy that actually has even better performance, okay? So I'm going to go ahead and switch now, folks, to our Absolute Alpha Bootcamp portfolio. Okay, this was started with just $100,000 roughly 3 months ago. Okay, its overall P&L for the year is $20,000 on just 100,000 bucks, guys. So you can quickly calculate that that's a 20% return. So almost double the performance of our Safe Alpha portfolio here, folks, for the year. And let's just, for fun, let's do the quick math and see what the outperformance here is to the S&P 500 on the Absolute Alpha Bootcamp portfolio. Okay, so once again, we're going to take a look at the performance of the S&P 500. We can see right here, folks, it's up 2.66 for the year. Okay, so I'm just going to write this out on the screen here. Okay, so the S&P 500 currently up 2.66%. Right, so if you had the same $100,000 portfolio just in the S&P 500, you'd have a profit of $2,666. Right. Okay, so and still good, right? And most people will be really satisfied with that. But with the way inflation is working and the devaluation of currencies, I would absolutely not be impressed with that in any way, shape, or form. Okay. So a little bit obsessed, folks, with returns that I get in the market, if you haven't understood that by this point. But this is our bootcamp portfolio. Okay, so I'm going to write that out here. This is part of what Jeff is following. Okay, Jeff did do the lifetime membership to the bootcamp. That is an option you guys can take advantage of today if you'd like to. Okay, but this is our bootcamp portfolio. And if we take a look here, we look at the $20,000 profit on just $100,000. Well, folks, we understand that that return, okay, is 20.47%. Okay, 20.49 here to the tick. Okay, so let's go ahead and write that out. Even though it just ticked higher, I'm going to use the number that we saw when I was verbally expressing what was on the screen. Okay, so bootcamp, okay, is up 20.49%. Conversely, the S&P 500 is up, right, 2.66%. So barely staving off inflation. And let's do the metrics here, guys. Okay, and take a look. And look, this is our portfolio set, right? There's no games here, folks. There's no gimmicks. We let the bullshit walk, and we let the money talk. Okay, that's our motto here at Portfolio Builder. Okay, but just so you guys can see the difference here. Okay, and I'm going to take a different color so you guys can see the difference between the S&P 500, what it's done, okay, and our boot camp. Okay, so if you guys like the Safe Alpha, and if you have more of an aggressive, set to your mind, and you're able to do that because you have your bills taken care of, right? You have a good job, that's fine, right? And our younger clients absolutely love this, and actually our older clients love it too. But they're typically building these portfolios for their kids, their grandkids. Okay, so it's kind of cool. So our outperformance of the Safe Alpha guys was 448%, or a factor of 4.4x. Okay, let's take a look at what the outperformance factor is on the bootcamp. So I'm going to take my notional 20.49% return for the year. Okay, I'm going to take that and divide it, folks, simply by the return of the S&P 500, which is only 2.66%. Okay, so real simple math. We're using empirical evidence here. Right? You can't argue math. That's why I absolutely love it. And you can see the outperformance here, folks, is a factor of 7x or 7.6x, or a factor of 761% outperformance to the S&P 500. Okay, so very good, guys. Just wanted to quickly show you that different asset class here, different, completely just really different methodology and thought process here to this portfolio compared to the Safe Alpha. A little less diversification. This portfolio currently holds just under 100 companies. Okay, and the Safe Alpha owns roughly 150 companies. So you get a little bit more diversification with the Safe Alpha, a little bit less with the boot camp. But if you have, that aggressive taste to your investments, this will get it done for you, certainly.
And I did get it fixed, so I can swing back now.
Okay, perfect, Jason. Go ahead, bud.
Okay, wonderful. So this is how we express our trading plan to our clients. And I know I just said, hey, for every testimonial, there's probably an opposite testimonial. That's a legal disclaimer we must say. Next thing I want to say is this is how we actually have become so popular, is by having a trading plan that our clients can follow and everyone gets the same results. Okay, so I want to point this out, is that every single member following this trading plan, unless they're going off on their own path, they're going to have the exact same results as you will over the same period of time. And it's because our whole trading plan revolves around having a ratio of shares to build out units of investment. So I'm going to show you how to build out 1 unit in our Safe Alpha Advisory with our current trade recommendation. And after we go through the 10,000 foot overview of why this strategy is so brilliant, we're going to come back and I'm going to let you tell me how much money you want to test drive in the product. And I'm going to screenshot this and email it to you. So let's say you had $100,000 you wanted to put behind the program. It's going to automatically divide the unit cost of $1,189 into the total investment, and then it's going to multiply it out by the ratios. And so it's just a handy little calculator that's going to make sure everybody following has the exact same ratio of shares so that you get the exact same return as Dean, as Jeff, as I do, down to the penny. Okay, not down to, almost the same return, not close to the same return, not kind of the same return. You're going to have the exact same return to the split penny during the same period of time that you own the same ratio of shares. So let's just break this down really quickly so you understand how to read it. And then we're going to go through how to follow this and why it works so well. Okay, so right now, 1 unit costs $1,189 to build. And here's what's inside your trading plan. You're going to have a defense, which has 11 shares of the product UVXY. Okay, so we've seen this go up 50% with that little sell-off to start off February. And it's come right back down. You're going to find that UVXY goes up much faster than stocks go down. And that's really important. What it means is you can have a small position. So you can see right now, $114 is what we call our insurance policy. Okay, and that's relative to $1,189 in the market. So it's just shy of a 10% insurance policy. Now, when stocks go down, this thing screams up. It was just a couple days ago, this was trading at $14.50. Okay, so it jumped up 50% when stocks only went down a few percent. So it's just a beautiful, beautiful way to reduce volatility in your account. Now, about 3 to 4 times a year, you get a pretty good panic in the stock market. Okay, so we're not looking to sell our UVXY unless it's going up 100, 200, 500%. Those are the type of sell-offs where we're going to cash out our insurance. And then guess what we're going to do with the profits on our insurance policy? Can anyone guess where we're going to reallocate that capital? You got it, right back into stocks. So when everybody's panicking that, oh my gosh, stocks are going down, you're going to be the guy that has a massive hedge protecting you against that risk, patiently waiting to dump your insurance and buy more stock. Meanwhile, what's everyone else doing? They're going to be praying that the sell-off stops until they finally get so scared they sell, and they end up buying high and selling low. Okay, so what we're going to teach you to do is buy and hold, because you're going to understand the big picture. What's going to take the triple Q up 10,000% in the next decade. And why the worst thing you could ever do is sell your stocks. The best thing you can do is buy insurance cheap and cash it out expensive. Rinse, wash, repeat. Okay, that's really our simple goal here. We want to give you the confidence and hedges to hold the triple Q indefinitely. And we're going to explain why. But just to put, simple math together, the opportunity is to turn every $1,000 that you put behind the triple Q into $100,000 in the next decade. Okay, so if you have $1 million in the triple Q, you could literally be looking at $100 million portfolio in a decade from today. I know that seems outrageous. We're going to show you why it's not outrageous at all. Okay, so that's the plan. So first you buy your insurance. You pick up 11 shares of UVXY. Step 2, we're going to buy 8 shares of the TQQQ. That's your moneymaker. Okay, that's the big prize. Next, we're going to hedge against inflation and devaluation of currencies. So we have a massive currency war happening worldwide. Right now, the US has led the devaluation of the dollar. But guess what? Now Europe's currency is outrageously high, and the Chinese yuan is outrageously high. That's going to absolutely destroy their exports. So, what do you think China and Europe are about to do? They're about to turn the printing presses on so that they don't destroy the exports of their country or their continent, for Europe's example. So, Bitcoin's a beautiful play. We're seeing all the big institutions come in, and we just had a huge money manager put $100 million into Bitcoin, and it only represents about 1/1000th of their total assets. Okay, 1/1000th, and that was a $100 million starting position. So Bitcoin has a huge future. Ray Dalio just said it's a brilliant invention. Elon Musk has it on his Twitter feed. Okay, so everybody's reading the writing on the wall, and that's that the global elite have a very simple plan. Okay, and that's take turns printing money and bubbling up financial assets, which they own almost all of, so that they can protect their wealth. They really don't care if the value of a currency is losing value at the fastest pace in history, because they don't work in those terms. They work in how much money do they have in the stock market. So we'll cover that in a little bit. Okay, next is you got to realize there's going to be a massive shortage of electric vehicle batteries, okay, in the very near future. Okay, there's really two great ways to play that. There's copper and there's lithium, there's cobalt. There's a handful of these rare earth metals, but I like copper the best. We're not trying to go into a tiny niche market. And copper is absolutely going to be critical for the electric vehicle revolution underway, for climate change, and it's used to build everything under the sun. So we're actually looking at copper as a greed play because of the global climate change agenda, which is in full throttle right now, one. But two, there's one thing that growth stocks really don't appreciate very much, okay, and that's rising interest rates in the bond market. Okay, so what causes that? Inflation in commodities is really the key to making the bond market get quite upset. So the best way to hedge your tech stocks is to go long commodities that go up in price during a real recovery. So the best commodities that we like are oil and copper. We've decided to put copper in this portfolio because it's had a lot less volatility as oil, and it's really getting a demand side push. We're seeing oil prices go up because of regulation, but we're seeing copper go up because of demand side growth. Okay, so we're not going to be too worried about getting the best return going into lithium or cobalt or anything of that nature. I get a lot of questions about that because copper is the biggest market after oil when it comes to commodities. So we really believe copper is going to be the single best way to hedge against reflation, rising interest rates. Okay, so once again, the whole plan is really designed about guarding your growth stocks. Everything else is secondary. It's all protecting the king of the chessboard. Which brings us to the rest of the presentation. I'm going to come back to this in a moment, and we're going to start building out portfolios live for our audience. You're going to tell me in the chat box how much money you want to test drive in the system. I will screenshot this, email it to you, and put you on the trade alerts. Okay, so we'll come back to this in a moment, but let's talk about why this prediction is such a strong prediction to invest your money in retirement. And so the headlines today is that Schumer's going to cancel student debt. Mitt Romney wants to give all the parents, I think it was $4,200 or $5,000 for each kid. They're looking at a new stimulus check for $1,400, and we want to extend unemployment benefits. Bottom line is we're paying everybody to stay at home and do nothing productive. Okay, so we're just going to blow out our deficit and devalue the dollar for what? Well, you're going to see what for what in a moment here. And again, what we really want to stress is that you should not be trying to pick micro cap stocks that are going to be the next Amazon. And unfortunately, we're living in a world where Amazon is going to gobble up. They're going to do one of two things. If there's a threat to anything related to their business, they're either going to buy it out and put it in their stock, or they're going to crush it. Okay, that's the two things that are going to happen. And these guys are getting more powerful by the second. So what we're going to argue to you is stop trying to pick stocks. Let's just figure out where the richest people on the planet are storing their wealth and assume that we're not smarter than they are, one, and that two, they're going to do everything in their power to guard their wealth into the future. Okay, so let's just start thinking like a billionaire and copycat what they're doing. In fact, the strategy we're recommending was created and really made famous by an investor named Ray Dalio. So he really made risk parity popular, and he's generated more profits for hedge fund investors in terms of total profit, probably than all hedge funds combined ever. Just insane. And he didn't get there by getting the best return per year. He got there by having the least volatility and the safest profit. Okay, so that's what we're all about here, is how do we generate safe profits and protect wealth? We're more concerned about drawdown than we are about absolute return. Okay, so if you're looking for the next get-rich scheme, this is the wrong place. If you're looking about a strategy to guard wealth in retirement and copycat what the richest people on the planet are doing, then you've arrived to the perfect webinar. Okay, so who are the most powerful people on the world? It's the tech giants, without question. Now, Forbes needs to update this list. Elon Musk is the champ for the time being, but it's basically all the companies in the NASDAQ you're going to find happen to be the owners and richest people on the planet. So we're talking about Apple. That's where Warren Buffett's all in. And pretty much every central bank, pension fund, hedge fund has a massive Apple, Microsoft, Amazon position. If they don't, they've been fired by now. Okay, we got Microsoft, Amazon, Facebook, Google, Tesla, NVIDIA, Comcast, PayPal. These are the tech giants leading the frontier of new technology. They're the companies that are going to create this sci-fi future that you've seen in the movies. They're the companies that are growing revenues and profits faster than all of their peers. They're the companies who spend more money lobbying every government worldwide than every other industry combined. Okay, they absolutely control the government. Not only do they control the government, they also control the dialogue. Okay, try to say something that is negative about what they believe. You will quickly be kicked off of every platform and ostracized. They're completely controlling the world. What else are these guys doing? We talked about buying out all competition. Okay, so don't even think about competing against these guys. You'll either be destroyed, regulated, or bought out. They have access to the corporate bond market at the lowest interest rate of all other companies in the world. That means they can borrow unlimited amounts of money to do what? Well, guess what they'd like to do? This is what really drives their stock higher. Okay, besides spending the most money in R&D, taking leaps and bounds ahead of everyone in AI, big data, robotics, automation. Okay, you can kiss that Amazon job goodbye in the next decade. They've got robots doing everything. Okay, what else are they doing? They are doing stock buybacks. I don't think people understand what's really happening when a stock buyback occurs. So as Apple is now growing revenues 11% year over year and expecting accelerated growth into 2021, guess what they're doing with the amount of shares that get to fight over the profits and earnings of Apple? Do you think they're issuing more stock and raising money? No, they're doing stock buybacks. So as their revenues are growing 11% year over year, they're reducing the number of shares by a few percent a year. In fact, over the last half decade, since Buffett got so involved in Apple, they have reduced outstanding shares by about 20%. So as time marches on, the number of shares of Apple and Microsoft and Amazon is reducing. It's shrinking, becoming more scarce. Okay, so it really doesn't take a rocket scientist to realize what's going to happen to the value of Apple's stock if they continue to monopolize their industry, grow profits and revenues, and then shrink the number of outstanding shares. What do you think is going to happen to the value of their stock? Of course it's going to go up. Now there's another phenomenon happening that's also helping, and that's the retail call option mania. Right now we have retail investors going all in on short-term call options, really on this group of stocks primarily. And so who's selling the call option? Well, it's big money does that. And here's what they do. If you want to go buy a call option on Tesla, you're going to pay a premium of anywhere from as little as 20% if you're way out of the money, and as high as 50% if you want a near the money call option. It's outrageous. Okay. The person selling the call option loves it. They're going to take your money with a big smile, and they're going to hedge in two ways. They're going to buy 100 shares of Tesla. So if the stock goes up, they hand over the shares and they keep your huge premium. They cannot lose if it goes up. They might take some of that premium, which they consider free money, and also hedge by buying a put. Okay, so it's a very beautiful strategy. And what's happening is now over 10% of all the trading volume in the stock exchange is call options. Okay, so this is creating an absolute mania, a melt up. So that's the big picture of why stocks are going up. And what's about to happen? We're about to ship everybody a $1,400 new stimulus check and continue unemployment benefits so that everyone can stay at home and be a professional day trader. So our prediction is that the market's about to melt up much higher. And we're going to talk about what might create some volatility in the interim, mainly the bond market. But the big picture is really set in stone. You're going to see what's coming next is really going to be very hard to alter the path of what's coming next. So let's go ahead and jump into that. Now, first of all, I want to point out that the monetary policy and fiscal policy that we see today is very similar to that of 2009. So again, here's what you can anticipate. We had a housing crash because of rising interest rates from 2005 to 2007. Eventually, it crashed that housing bubble. And the government didn't know what to do for a good year, but eventually they got their act together and they bailed out the banks for $1 trillion. And they started devaluing the US currency by about 1 trillion a year for 5 years. So this is the exact moment where they announced the quantitative easing right here. Okay, November of 2008, they announced the intentions to do this. What happened immediately? The stock crash ended and money began to plow into buying stocks. Okay, this is the NASDAQ. This is the stocks we just showed you. Now I want to show this. If you had bought into the NASDAQ at 2010, after this massive run up, right before a pullback, you can see today you're up 580%. Okay, and there's a pullback immediately after you bought it. Okay, you're worried that it's gone up too much. Well, guess what? Worst thing you could have done is try to time the market. And if you just bought and held, you turned every $1,000 into $5,800. Not a bad return. Or you turned $1 million into $5.8 million. Not bad. Okay, but what if we took a different avenue to invest in the market? Okay, what if we bought the TQQQ at the exact same date? Okay, so instead of making a 500% return, by using the TQQQ, you turned every $1 million into today $108 million with no selling. Okay, you ignored the crash in 2018 because the Fed tried to do quantitative tightening, which was a disaster. And of course, they reversed course immediately. You ignored the global pandemic shutdown. okay, which was one of the most vicious stock crashes in history. You did nothing. You just bought and hold. You're up 108 to 1. Every dollar is now worth $108. So what is the TQQQ? They're going to take every $1,000 worth of Apple, Microsoft, Facebook that you would normally own and give you $3,000 worth of exposure, tripling your net worth in the stock market overnight. And it doesn't just triple the return, it hyper compounds the return. The longer you hold, the more this compounds. Okay, so that's why we can deliver such better results with less volatility. It's because we realize this is outperforming owning the same stocks 20 to 1. You're going to generate wealth 20 times faster by owning the triple Q than you would owning Apple, Microsoft, Google, Facebook outright. And what that does for you is it allows you to have less capital behind that ETF and further diversify your money to protect against any risk. Now, I'm going to tell you there's really 3 key risks. Let's go back to this trading plan so we can talk about these 3 key risks. Okay, one risk is that at any time, a black swan hits the market and creates a panic. Okay, so there's a lot of reasons why stocks could temporarily go down. Now, we're going to argue that until we're in a hyperinflation era, which I believe is at least a decade, maybe 2 to 3 decades away, all dips should be bought. In other words, we want to cash out our insurance and believe that all dips, until we do have lots of inflation, are going to be buying opportunities. So who cares why stocks go down? If they go down, you own crash insurance. I'm going to show you what this did. Let me show you that real quick. Look at what this did just with a mini sell-off. Okay, this went from 1030 to as high as 15. Okay, in 5 days. That's your insurance policy doing its job. Now the market rebound right back and it came right back to this level. And that's exactly how we want it to behave. We want it to go up faster than stocks go down, allowing us to get away with about a 10% hedge in most environments. But look what happened to this in March. Okay, now in February, people had the attitude they have today. Nothing can go wrong. We just signed this historic trade deal with China. Stocks only go up. And most of the time they do. We're going to talk about why. But look at this. All of a sudden, you get a panic in the market. You get the second most vicious stock crash in history outside of the Great Depression. And UVXY does its job handsomely, going from $10 to $134 in less than 30 days, completely offsetting all downside risk. Okay, so that's your hedge. Now, in our premium webinars, we go into a lot more detail. Right now, I'm giving you the 10,000 foot overview so that you can test drive this with the amount of capital you're comfortable with. And today, you can get your insurance super cheap, extremely cheap. Okay, so one risk in stock market is billionaires sell for whatever reason, creates a panic, creates a domino effect, you get a vicious sell-off. You have nothing to worry about. You own UVXY. And again, we're going to tell you when to sell that and buy more stock, because when there's blood on the street, you want to be a buyer, not a seller. Okay, step 2 is generate profits 20 times faster by getting free money from the ETF, the triple Q. Okay, when you triple your investment over a decade, you're not getting 3 times the return, you're getting 20 times the return. Next step is, what if the dollar crashes a lot worse than everybody's anticipating? That could absolutely create a financial crisis. And with Democrats in control, guess what? They're planning to spend $2 trillion in stimulus every 3 to 4 months. Plus, they want to do a $5 trillion climate change to rebuild all of America with solar panels. It's absolutely ludicrous. But again, if you can't beat them, join them. So there is a great risk that the dollar just falls through the floor. If that were to occur, it could crash everything, all markets. Bitcoin would just skyrocket. Now it's going to go up just from a currency war, but what we're really worried about is the dollar absolutely collapsing and having pain in stocks, in US stocks. So that's a good hedge. Finally, the other real risk to going long growth is it's very sensitive to rising interest rates and inflation. So we can express that belief that we do have inflation incoming by being long the copper miners. Okay, so you're starting to see how this all pulls together. Each asset is really geared towards protecting your growth stocks. So let's look at some more charts here. So UVXY is your crash insurance. Let's talk about what's really driving the stock market higher in total. This is looking at our federal surplus or deficit. Now, what do you see here? Do you see a government that is running a profitable business strategy? Or do you see one that's basically going into unlimited amounts of debt? Okay, when I look at this, it reminds me of like a 18-year-old daughter who's on the last 20% of her credit card limit and has no intentions to get that debt paid off. She's going to just blow it out as long as possible and worry about how to pay it off later. And that's exactly what your government's doing with its deficits. Okay, this is trillions of dollars per year that the US government's spending, which it does not have. So how does it do that? Okay, this is from the Treasury. This is a look. December, we spent we collected $346 billion in taxes. We spent $490 billion. That's a deficit of $150 billion. If you actually go into the details of what the US government's promised its voter base, the liabilities of the future are $100 trillion. $100 trillion. How are we going to come up with the money? Okay, we're already $32 trillion in debt. It's outrageous. So their plan is simple. They want to devalue the debt by printing money. It's really that simple. And they're going to make all these obligations come true by printing money. Now, does wealth come from printing money? No. Okay, it just dilutes the value of every dollar in circulation. It absolutely does not create wealth. Okay, production in the economy creates wealth, not printing dollars and diluting the value of each. And so if we come down here, these brown little blocks represent the value of the dollar going down. Now, I want to tell you, these little blocks are massive, massive. These ones in April, May, and June, you need to realize we printed more money in those 3 months than we have in 100 years of America having its own central bank. 3 months. Okay, so if you're in cash, guess what? Sit there and watch the purchasing power erode by 10% a year or more. That's what you're going to really see, is that if you have $1 million today, next year it'll buy $900,000 worth of goods. If you wait 5 years and these policies keep going on, your $1 million will be worth $500,000. It's outrageous. Now, how do we get away with it? Well, let's talk about how it works. So we sell bills, notes, and bonds. I'm going to tell you, this is the big secret to the stock market. Understand the bond market, you'll understand everything else, including the single greatest risk to the stock market, which would be the inability for the US government to continue growing its debt bubble. So here we go. Here's where we issue our debt. We're actually having to refinance $8 trillion of old debt this year. And I'm anticipating at least a $4 trillion deficit. Okay, that's a massive deficit over last year, which was $3 trillion. Just insane. You gotta realize that's 9 zeros. Oh, excuse me, that's 12 zeros. Okay, 12 zeros worth of money printing. Where's all the money going? Who benefits from this? So we have a setup where primary dealers buy all US debt. And guess who buys most of it? Good old JP Morgan. Okay, now what did they just pay $1 billion fine for? Manipulating precious metals and treasury market. Why would they do that? So here's the deal they have. It's really a nice deal for them. Makes billions of dollars a month of guaranteed profits. So they love when the government does this. They get to go borrow from the effective federal funds rate of 0%. This is what we do every time we get in economic turmoil, and why you want to buy stocks when your economy is wrecked and sell them when they're fixed in general. Okay, it's because the government and central banks try to manipulate the future. And so what do? You wreck your economy. Here's what they're going to do. Step 1, lower interest rates to 0. Step 2, go pass a massive budget that is way bigger than the income of your country. Step 3, issue this into the debt markets. Step 4, have primary dealers gobble up all the debt by borrowing from the Fed for free. Now, who does JP Morgan sell this to? Pension funds, central banks, hedge funds. Okay, anybody foolish enough to lend money to the government gets to pick those up. JP Morgan makes a huge, massive profit just on transaction fees. Now, what does JP Morgan do with all the debt no one wants? Do you think they hold it? Oh, hell no. They unload it right back to the Fed. This is what we call quantitative easing. And so I just want to point this out. Okay, where was the bottom of the stock crash? Exactly where this quantitative easing begins. Okay, it's not a question now. If you start to devalue your currency by expanding credit at your central bank, bonds go down, dollar goes down, stocks go up, commodities go up, rare metals go up. Okay, it's really simple. And what stops central banks from printing money? Too much inflation. So we're going to talk about how to predict when they're going to stop doing this money printing mania. And again, it's going to take a long time. Okay, so 1 trillion did the trick. They did another trillion, another trillion, another 2 trillion. Now, what happened that entire period? Stocks skyrocketed up. Now, 2016, you can see the second Trump came into office, all of a sudden money printing's bad. They actually tried to do quantitative tightening. Okay, so we could tell what the big bankers thought about Trump. They did not like him. I want to point out that even though we stopped printing money in 2016 and did tax cuts, which a lot of people say is what drove the stock market higher, I'm going to tell you, no, maybe not. Let's see what happened with Europe's central bank and China's central bank from 2016. What if I told you that these central banks are taking turns printing money so that they can ensure the least volatility possible in the stock market and continue to grow the wealth of the super rich who have all of their assets parked in real estate and stocks? Okay, let's see what they did. Oh, looks like Europe went on a printing spree in 2016 and are also printing at the fastest pace currently. That's interesting. What about Japan? Oh, wait, they were printing money as fast as possible as well in 2016 and never stopped since. Okay, what about China? Okay, now they don't have a bond market like we do or a freely traded currency, so they just straight up lend money right into the economy. Okay, so they have what's called a shadow banking sector. So we want to look at their credit impulse to get an idea of how much money printing they're doing. And what did they do right in 2016 and 17 and currently? Oh, they punched the pedal to the metal and started printing money. So is it any wonder why stocks have gone up for the last decade? Of course it's not. We're devaluing fiat currencies worldwide. So here's the purchasing power of the dollar over the last century. Okay, except for the Great Depression, the value of the dollar has been crushed 98.5%. Stocks have gone up that entire period overall. Okay, if we look at a few things you really spend money on, medical costs are up 550%. Shoot, just electricity's up 1,000%. So the cost of everything that's rare or scarce is going up. The value of fiat currencies are being diluted at the fastest pace in world history. Okay, so that's really what's happening. So it's great that Apple is, taking over control and buying back their own stock, and call option buyers are going all in, forcing broker dealers to cover by buying 100 shares, creating this melt up. But the real reason, the real push of the money flow is that the dollar's losing value, the bond market's getting crushed. So where do you go? You have no choice except for stocks, commodities, and metals. Those are the rare things in the world that are going up in value and storing wealth. If we did look at the 1980 CPI model, we're already at 10% inflation. It's going to go way hotter because we've printed for every dollar in existence 40 cents and growing in the last year. So what do you think is going to happen to the cost of everything? It's going to go skyrocketing up as we reopen the economy. Now, here's what the Fed's told us. When are they going to stop this mania? As soon as they get inflation to 2.5 on their core inflation data, okay, which is this bizarre model, it has nothing to do with actual prices in the economy. And they're going to let it run hot at above 2.5 for as long as they've kept it below 2. So right now we've seen 9 months of inflation below 2. Okay, so we have nothing to worry about in terms of monetary policy from the US until this inflation gets really hot for a really long time. Okay, and spoiler alert, until the labor market's recovered, which is probably going to take 5 to 10 years, this is not going to go above 2. So bottom line is prepare for volatility and hold on to your horses. The stock market's about to have the best return in the coming decade than it's ever had in history because governments are trapped printing money faster than they ever have before. And there's no way out of it. Okay, there's no government that wants to promote austerity and balance the budget. All they're talking about is how much free money should we hand out to everyone. That's all they talk about. Okay, so that's really the big picture. Bonds are getting trashed. Here's a look at the bond market. This is just horrifying. If you're holding treasuries, good luck. You're probably going to lose 30% in the next 12 to 24 months.
That's a lot of mutual funds too, Jason, hold such large bonds positions, just like they did in 09, 010, 11, and just got crushed. So if you're in mutual fund, guys, pay attention to this as well.
Yeah, risk parity, old school risk parity is just getting completely trashed. So if you own bonds, it's just a leverage bet on the future value of the dollar. Well, I can tell you what, the future value of the dollar is down, okay? That's an easy prediction. The value of your dollar will go down as long as the government continues to spend more money than it makes. And the voter base is not going to vote in any kind of balanced budget or austerity of the dollar. They do not think of that. So it's just really sad. So now you understand why Bitcoin's going up, why everyone's starting to get a tiny position in it, and it's just going to get bigger and bigger. Okay, we can look at Dr. Copper to predict the stock market and interest rates. And if copper is going up faster than gold, that's signaling reflation, growth. Okay, we use copper to build things. So that's what we're looking at. And it's playing out perfectly. Our clients are doing really well. You know, I don't know how to really explain this anymore to you, but we've got all your bases covered. Here's rare earth metals. So this is the only other ETF I would consider against copper, just for fun, looking at it, competing. So REMX is, unfortunately, a bunch of Chinese companies who control all the metals that are important for everything we use, from cobalt to lithium to copper and a whole bunch of others. I think there's like 40 of these rare metals that do all kinds of high-tech things. So we're looking at that as an opportunity. But look at copper just really dominating. If we showed oil compared to copper, oil is so volatile and really under attack by regulators. So we prefer copper as the safest way to hedge against rising costs. Okay, and also the byproduct of copper is also silver, which we like as well. So copper miners are a great setup. They're going to make a ton of money, and that's our hedge there. Here's a look at interest rates. I don't think the selling is going to stop in the bond market till we get to 3. So that's when we'll get you guys back in bonds. So there's another 30% loss in anyone holding bonds before we'd even think about allocating there. So where are you going to go? You have no choice. You really need to follow this trading plan. Now, what would change my opinion? What would really change our strategy? Well, we got to realize the globalization of the economy and ultra cheap labor in China, plus realize all jobs are getting replaced by robots. Okay, that's making the core inflation rate that governments react to suppressed for 4 decades. And technology is growing at an exponential rate. Okay, so they see the writing on the wall. They're going to have to continue doing, we're moving towards universal basic income. So they just want to pay you not to revolt, basically, while they replace all the jobs with robots. That's what's happening. So I highly doubt you're going to get a whole lot of inflation. because you're not going to have a strong labor market. And the reality is that most jobs can be replaced by robots. So if you did get runaway inflation like the 70s, we'll give you a totally different trading strategy. And I'll just point that out. So I want you to know we're well aware of all the bear markets. We have a great history of making money in down markets. Okay, so we love to be the hero who protects wealth during downturns. Okay, not many people do that very well. So we're well aware of the 15-year bear market in the 70s that was caused by hyperinflation. To pull that off, I think you would have to have a populist revolution that decouples the economy from China and bans robotics and automation and really pushes towards labor. Okay, that's how you get some runaway inflation for a decade. I just don't see it happening this decade. This decade, I see us facing deflation, an inefficient economy, and governments that believe if they spend even more money, they'll eventually fix things. And the reality is they're not fixing anything. They're just devaluing their currency and handing out trillions of dollars to their donors who do what? They put all the money in the stock market. They're not stupid. Okay, so we're well aware of the 1965 hyperinflation. Let me show you that one more time. This is what would change the game. Okay, you get this hyperinflation that's uncontrollable. We'll show you how to play that market. My bet is the next decade it's the opposite, that we're continuing to struggle to get any economic growth, and we're having low levels of inflation because we have a low labor force participation, because robots are taking over the job market. We're automating everything. We're globalizing the economy. We're outsourcing all the work. So you're just not going to have that red hot inflation that everyone's worried about. Okay, so bottom line is, yeah, we're bullish on the triple Q. We think the coming decade will be better than the previous decade. And it's not for good reasons, I'm afraid to say. It's not for good reasons. It's for really, really sad reasons, at least for your average Joe human. Okay, great. So let's go ahead and build some portfolios. Let's pull up the poll. Let's see how much money people are losing to inflation. Wow, up to 6% in February for Safe Alpha. So very good for everybody following the trading plan and following course. Okay, guys. So now that you understand what's really happening, you're not going to blink. You're not going to even blink when you put this trading plan to work.
Okay, guys, and just real quick before we do get some portfolios built out, 2 quick questions to fill out in the poll. And just know, folks, it is completely anonymous. The only thing that Jason and I will see is percentages, right, when you guys respond to this. So just be completely honest when you fill out this poll, guys. It's really helpful for you guys to understand what your cash inflation fire looks like today. Okay. So real quick, folks, you're going to see a white and green screen that popped into your Zoom technology there. Okay, and the first question is, investors, it's critically important to review how much cash the Federal Reserves around the world are burning in your ecosystem. Let's seriously think about the cash you have sitting in your brokerage/bank accounts today in this exercise, and please select a response. Okay, so there's a couple options to select from. Some people will have a couple $1 million sitting in cash. Some will have 500 to a million, 500,000 to a million in cash. Some people will have 200 to 500,000 in cash. It looks like some people that have already responded have 100 to $200,000 of a cash fire. Okay, some people have 50 to 100, 25 to 50, and then some will have less than 25,000 in cash currently. Okay, and then folks, there's a series of responses below that, just basically to help you guys understand why you're sitting in cash. Okay, looks like so far 25% has said, I honestly had no idea. Inflation is burning my cash at the fastest rate in U.S. history. That's typically our number one answer. Typically, our number two answer is, I'm looking for a safe portfolio/system to invest with currently. Okay. The next one, folks, is I had big losses in 2000, 2008, and Q1 2020, just hesitant to the due to the big losses. That's actually our number one response today, guys. And that's why risk parity is so beautiful, right? And it's really neat because our volatility hedge is depressed significantly once again here, guys. So wonderful entry point to the portfolio set here today, guys. And look, if you it's funny that really a lot of really wealthy people will text me and they're like, Dean, is today a good day to enter the portfolio set? And I say, well, what would you rather do? Would you rather put your money to work, or do you want it to go backwards? Okay. So yeah, guys, look, you got to understand, I don't care where you are on planet Earth today, you're losing 10 to 25% of the value of your capital every year. Okay. So you can continue to do that with the cash that you have in your bank, in your brokerage account across the two. Okay. Or you can start growing it. Right. And currently, guys, if you're sitting on a cash pile, right, you're really actually physically sitting on a cash fire because it's devaluing literally by the day. So just a helpful exercise, guys, to really help you kind of, really understand where you are, what that cash inflation fire looks like. Okay. And it looks like we do have a couple people, Jason, over a million. So we will, for those that have over a million in cash, folks, we will show off our Safe Growth Pro portfolio as well. Okay. All right. And with that, guys, it looks like 36% of the group has filled that out. If you haven't yet, please go ahead and do so. And once you get that filled out, guys, we will jump in and start getting portfolios built out. So once we get some more respondents, we will certainly get some portfolios built out, guys. This is the best part of the webinar. This is where you can test drive risk parity literally at no cost. Okay. So pretty cool. If you've ever taken, let's just say, a test drive in a car before you buy it to decide if you like it or not, we're giving you that opportunity right now. Okay, to put our portfolios to work. Go drive them. Right, see what it feels like, see what it looks like, and for a lot of you, right, you're going to be making a lot more than the cost of our service during that test drive. And if you're coming back from being on earlier this week or from being on last week, well, you've probably already made a couple $1,000, and if you have a larger account, you probably have already made 10 or 20 grand. Okay. So this is that opportunity at this point, guys. It looks like we are at 42% here, Jason. Good group here, good mix of respondents. It looks like so far the number one reason for people letting their cash fire burn today is they had big losses in 2000, 2008, and Q1 2020, and they're just hesitant due to the big losses. So beautiful, Jason. I love when that's our number one answer because we have their solution right in front of them.
Okay, great. Now, can you explain how they can find their chat box on the computer or phone to post their test drive amount?
Yeah, absolutely, Jason. So folks in the webinar, okay, so if you're on your desktop, okay, which most of you probably are on the desktop, what you want to do, folks, is take your mouse, scroll down to the very, very bottom of the screen. Okay, when you do that, folks, a gray bar or a black bar is going to pop up depending on your computer. Okay, and when you see that bar pop up, whether it's gray or black, you're going to see a couple icons. Okay, in the bottom left-hand corner, you're going to see the microphone icon. So you can simply unmute your microphone if you want to speak with us directly. There's also a chat icon. Okay, and there's also an icon to raise your hand. So feel free, folks, to just type in to the chat or simply unmute your microphone, guys, and talk directly with us. Okay, either one will work. Okay. All right, guys, and with that, looks like and Aiko did write in, Jason. He has 100,000 to start with, and Aiko, do you want to build a portfolio with 100,000 to allocate today? And if so, just type in your name, your phone number, and your email, guys, and we will get that sent over to you directly after the webinar, so you can put it to work. Okay, test out risk parity, see what it feels like, and our intention, guys, is to make you as much money as possible, not only during your free trial, right, but over the next year and decades to come. Okay. And Bill, I see your microphone is unmuted. How much would you like to test drive today, Bill? Okay, guys, and don't be shy. Make sure to type into the chat box, unmute those microphones. Okay. Jason Barry would like to put $100,000 to work. Okay, and yeah, so Barry, are you in the United States of America? Okay, cool. Barry, actually send me your email, bud. I'll send you a referral to TD Ameritrade. And if you open an account there and deposit 100 grand, I think they're going to give you like $200 or $300 if I refer you over. Okay. So just type in your email, Barry, and your phone number to the chat box. We did see your 100,000 amount, so thank you for that, bud. But make sure to just enter that email and that phone number. And what I'll do, Barry, is I'll actually send you a referral to TD Ameritrade too, and they'll actually give you a couple $100 for just opening the account. Okay.
Okay, I do need Aiko and Barry's email and phone number. The phone number should be your cell phone because we're going to send you trade alerts. If there's any kind of stock crash coming, we're going to give you a stock crash warning text and tell you what to do to protect your account. Okay, so very good. Nice. Otherwise, you just sit back and let this puppy just do its work. We do very little trading. This is very passive. And guess what? We smoke everybody else's returns with less work. That's why people love this program. Aiko, can you please share your email and phone number in the text in the chat box for me? Okay, John Furda is coming in with 30K. All right. John, same thing. Post your email and cell phone number. If there's reason to be alarmed, you'll get a trade alert telling you exactly what to buy and sell to protect against downside risk. Now, we already have a huge 10% hedge. Yeah, John, if you'd rather do 10,000 a month over 3 months, that sometimes lets people feel a little bit better about it. Would you prefer to do that? I'm not going to tell you you're going to make more money that way, but you might have less volatility. You'll have less timing risk if you do that. So that's not a bad strategy. Okay, I'm going to give you a 10K to invest per month and get this out to you right after the webinar.
Okay, and Barry, I did send you that referral there too, bud. So you're gonna have an email from TD to take a look at. Okay, and pretty cool, just free money to open up that account. And by far, guys, so if you're in America, really, if you're in North America, actually, I should say, definitely the broker we do recommend, guys, is TD Ameritrade, but you can use any broker under the sun, right? So the broker is just the access in and out of the market. The only thing I would tell you is you may not want to use Robinhood because they don't have phone support, and I'm not going to not have phone support for the type of money I have in the market. That's for sure. Okay. Nice. Thank you, Aiko. And then Aiko, just post your phone number too, bud, your cell phone, and then you're set to jet.
Okay.
Okay. And then Aiko wanted to do, okay, cool. Yeah, Aiko, TD is great, bud. Okay. And then just post your phone number, Aiko, and then you're set to jet. And Jason, Aiko wanted to do 100,000 as well.
Got it.
Okay.
Okay, cool. And Jason, a couple questions came through too. Okay, and I'm going to start from the top here. Let's see here. Joseph asked, are ratios important and why?
Yeah, that's how we all get the same result, Joseph. So that's the whole idea, is we all have the same ratio of shares. So we all get the same results over the same period of time.
Yep, great question, Joseph. Now, next, Jason said, CW said, do you set it and forget it? Or are you trading these ETFs on a regular basis? Currently driving.
So you want coffee, man?
Ready?
How?
Yep, 801, 801.
Less is more. So we prefer to only do trades when we think there's a paradigm shift in the market that's going to dramatically change the investment horizon, which is not that often. So I'm making tweaks very irregularly, maybe 1 or 2 trades a month until the paradigm shift occurs. Then we make dramatic changes. So bottom line is I want to deliver the best return with the least drawdown, assuming my clientele are either in retirement or nearing retirement, which means you have no new income and you have no opportunity to replace losses. So you need to be conservative and paranoid, really, in general, about all risks in the market. So no, we're not sitting there doing a lot of trading, but we do make about 2 to 3 trades a month. And when there's a big change, a momentous change in the markets, mainly from monetary policy, then we do make dramatic changes at that point.
Okay, and then next, Jason Joseph said, so no matter what, with UVXY, we will always make money even if the three offensive positions crash.
Yeah, so UVXY has an asymmetrical return relative to your stocks. 10% hedge is good for a extreme crash, and it reduces a lot of the volatility. It's not going to completely eliminate all downside drawdown. You have to go to about 20% hedge to pull that off. That's what we have in our pro. So if you really want to have almost no volatility on when the market goes down, our pro strategy, and we do provide a bonus. So we have two other portfolios. When you upgrade, you're going to get a free trial to our pro, which is more defensive, and our boot camp, which is more aggressive. So you can see our two other strategies if you do end up joining. Yeah, I can give you 10,000. Sure, Aiko, let me redo your screenshot. So we're only giving away the Safe Alpha product during our free trial. If you do end up joining, you're going to get premium webinars where we go into much more detail. And you're going to get a free bonus to try out our pro system, which is, again, more defensive. It's safer. It does better when the market goes down. And you're going to get a free trial into our boot camp, which is more aggressive or offensive. It does better when the market goes up. Okay, so we do have clients that are using all three, like Jeff, who you did talk to. Yeah, sure, Barry, I'll get you a 25K. But this is the program we like to start people out with to get a feel for our company, and then we go from there. Okay, so there's two other strategies that you get access to if you do end up upgrading into the paid program. But for now, this is what we're so confident will kick ass and make you a lifelong customer, that this is what we exclusively give out during our free trial. Okay, and remember the trailers go out right after we get off the webinar. Okay, who's next? So live, we have H. Johnson, Robert, Amag, Neil, Mari, Luz, Livy, Joseph, John, HR, H. Johnson, ED, CW, Barry, Andre, Ali, Aiko, Gary T, Bill, and Bazo.
Yes.
Who would like to get a portfolio built next? Gary?
Yes. Yes, I would.
Okay, what can I do for you, sir?
I'm trying to invest 100 grand in something that yeah, it's gonna just make me money. I'm sitting on cash, so that's why.
Oh, cash.
Yeah.
Chills go down the spine when people say 100 grand in cash. Did you want to
Yeah.
start with 100 grand, or you want to start with a little less? You want to try 25 to start?
How about 80?
80, all right.
Mm-hmm.
There you go. Can you post in the chat box your email and phone number, Gary?
Yeah. Yeah, sure. Here we go. Ram, I'm on my phone. That's
So right in the bottom is a little menu bar, and there should be like a
there
little chat button. Yeah.
Yeah. So you want my email?
Email and phone number. If there's any reason to get scared, I'll send out a trade alert.
Okay. All right, let's see.
The Safe Alpha's up 11% year to date, and the boot camp's up 20%. To get the boot camp portfolio, John, you do have to upgrade to our paid program, and then you get a free trial into the boot camp, so you can see if that's right for you. Boot camp is really, really doing well. That's my most popular webinar, and it is hosted every Thursday. But yeah, we want you to get the Safe Alpha rolling first. Usually I recommend 80% of your assets in Safe Alpha and only 20% in the boot camp, because it's riskier, and our clients are going into retirement or are in retirement. So we want to stick to the safer strategies and not be greedy. Okay, remember who wins the race?
Yes,
Turtle ends up winning against the bear every time eventually.
Every time.
Okay, great, Gary. I got you taken care of. So you get that trade alert in a minute, okay?
Okay, let me just, I'm sending it right over.
Okay, well, John, folks like you, I allow to go, as far as what I endorse, I let you go a little heavier on the boot camp, because you do have time, you have income. So I wouldn't scorn you publicly if you went a little heavier in boot camp at your age group. Okay, I got it, Gary. You're set. Good job.
Okay.
Nice, Gary.
All right. Thank you.
Yes, sir. Thank you for the interaction. We appreciate it, bud. Thanks for joining us.
Oh, yeah. No problem. My pleasure, actually.
Awesome, bud.
Love that greedy chuckle.
Yes.
He's like, send me that, Jason. Send me it.
Yeah, please. Trying to get this money moving.
Yeah, well, and the cool thing, Gary, is so many people when they see the volatility hedge, right, and then the currency deflation hedge, they go, well, why the hell wouldn't I do this?
Exactly. Yeah.
Right.
Oh yeah, because I was sitting back on this for close to a year now.
Ooh.
I just didn't know where to put it. So
let me ask you this: has your groceries gone up or down in cost in a year?
Wow. Well, see, it's funny. I work for the utility, and a lot of times we have storms, and basically we get fed at work. So
that's good.
That's never a problem.
Oh, too funny.
Yeah. So it's all built in.
Well, this trade alert will come out to you right after the webinar closes out.
Okay.
And you'll be set to jet. Yeah, excellent.
Okay, because I got to get back to work. But I appreciate it.
Okay, good job, Gary. We'll talk to you soon.
Okay, take care.
Okay, guys, who's next? Who would like a trade alert? Just find that chat box or unmute your mic, and we will get your trade alert built and shot out. Anyone else out there want to get started today? Okay, and the least you can put in is, okay, so this has gone up a few percent just since we've been talking here.
Okay, and Joseph was saying earlier in the chat that he had I think 150K in a CD and is making him $90 a month. So yeah, Joseph, we're gonna get you a plan that it will certainly grow just a wee bit faster than that. Okay, cool. Yeah, so whatever you'd like to start with, bud, whether it's $1,200 or you want to use 10 grand or 120 grand or 1.2 million, we'll build it out for you. And I'll be right back, Jason. I'm gonna hop on a phone call.
Okay. Ali or Al, I'm not sure how to pronounce your name, sorry. Post your email, phone number, I'll send you out the $1,200 screenshot, okay? And you can try it out with the minimum unit of investment. Okay, then I just need your phone number and we can give you the trade alert text message if you like. Very good. Okay, who's next, guys? Let's see. We still have live Bazo, Bill, Aiko, Ali, Andre, Barry, Edie, Gary, John, Joseph, Livy, Luz, Marie, Neil, Amag, Robert, Victor Cox, and John. So this is your chance. Don't be shy. Find the chat box in the bottom of your menu bar. Hit the little chat button. Just post how much you want to test drive. I'll send you your screenshot. And again, we'll be back tomorrow, same place, same time. Okay, would you like to try 1,200 or a bigger number than? Well, I'll send you that screenshot too. I'll send you two so you can decide what you want to do. No, Robinhood's fine. Okay, let's see. We have Augie just joined in. Welcome, Augie. Okay, very good, guys. And I do want to say, if you did get in a little late, right after this webinar is over, wait about 5-10 minutes and hit the same link that got you in here, and it's going to replay today's episode. So if you do want to replay the presentation where I go over the strategy for about a good hour. Okay, Mari would like to try 5,000. Good job. Marie or Mari, please post your email and phone number, and I'll get you that trade alert out, okay? Oh, Google Finance keeps screwing with us here. There it goes. Okay, got you taken care of there. Any other portfolios to build? Victor says, hi everyone, this is Victor. I'm your support person for all new members to ensure smooth and easy use of our system. If you have your mic there, Victor, go ahead and say hi. You're unmuted on our end. And very good. So we're going to go ahead and close out today's episode. We'll be back same place, same time tomorrow. So if you want to go do a little research, come back with some questions. I'll be happy to answer all your questions and get your portfolio built out. Joseph says, have you ever had a negative year, and by how much? No, I've not ever had a negative year. And we started in December of 2018 when you had that Christmas crash. And we were long treasuries at the time. So we actually squeaked out a profit in December when the market was tanking. We did well in the March crash. Really well. That's one of our best returns. And yeah, I'm a pretty paranoid guy in nature. So when I think there's a volatile stock crash coming, I tend to get really defensive and protect our clients' accounts. So sometimes that means the market may go up, and I'm going to be nervous and put you in a position where you can't lose if the market goes down, but we might miss out on some of the upside. So that has happened. Specifically in the election, I was worried the Republicans were going to create a constitutional crisis, not accepting the election results, and that it could have created a panic. So we broke even in November when the market went up. But I look back and see that as a real risk that we did a good job protecting against. So yeah, if you're worried about stock crashes, I am too. So I am very, as you can see, that's really my only concern. What could create a panic in stocks, and how do we protect against that? And so this is 10% hedges is okay for protecting against a crash. If I really thought that was what was imminent, I would get you to a 20 to 30% hedge and shave off some of our riskier offensive assets. Right now, that's not what I see coming, because we're about to send $1,400 stimulus checks. We're continuing unemployment benefits. So we got a whole bunch of folks who are going to keep betting up on the stock market with call options. We got a government that has no plans to balance the budget. So the dollar is going to keep falling. And I think Europe and China are about to increase QE because their currencies are getting too strong, which kills their exports. So there's one thing that worries me, and it's that bond market's crashing a little faster than I would like to see. But again, I'd anticipate that being a buy the dip opportunity. Joseph says, yes, my sister lives in Europe. Yeah, their currency's gotten way too strong. Okay, very good, guys. Well, I'm going to go ahead and close out today's episode. And If you have any questions, any email that we've sent you, if you reply, it goes right to me. There's no intermediary support desk. So I'm happy to help you with any questions. If you decide you want a trading plan later or a different quantity, feel free to email and ask for a new screenshot. If you do want to get a sneak peek inside the boot camp, which is more aggressive, or the pro, which is more conservative, that's a bonus when you do decide to get out of the free trial and join the rest of the group in the premium webinars. So you can get a feel for those two other strategies. Again, one's more aggressive, one's more defensive. And I just want to thank everybody for taking your time today to watch today's presentation, and come back tomorrow, same place, same time. Okay, so thank you guys so much, and we'll see you back tomorrow. Very good.
All right there, folks. How are we doing here? All right. Looks like Jason, are you still there, bud? Or looks like maybe Jason had to hop off. Okay, cool. All right, folks. Well, hey, if you all have any additional questions, feel free to give me a call. My number is 505-322 7515. Thank you all so much. Truly appreciate your time and attention here today, folks, to understand what risk parity looks like, and to help you understand how to put your capital into a tank opposed to being on a motorcycle without your helmet on. Okay. So thank you so much, folks, for your time and attention. Absolutely appreciate it. And if you do have any questions, just write down my phone number. That's 505-322 7515. Thank you so much, folks. Have a wonderful day and look forward to speaking with you. Oh, and Bezo76, do you have a question? Okay, looks like we are all set here, folks. So thank you so much for your time and attention, team. Do truly appreciate it. And we look forward to working with you. And if you all do get signed up, we will see you in the 3 o'clock webinar here today. So